Hi everyone, welcome back. Again, thank you for tuning in. For those that have never seen my videos, again, my name is Jiry Garcia. I'm a local realtor here in Orange County. And today I wanted to go over a few topics that came up within the last week or some announcements that have come up here in December. And I'm actually out here outside my patio. Excuse the noise, but such a beautiful day here in California, December, sunny day, a little bit chilly, but wanted to do my video out here today just to get out of the office. So here's what we'll be talking about. Conforming loan limits. These are the loan limits. The new amounts just came out last week. So I wanted to touch a little bit on that and explain to you how that works. Also, the Fed announcement regarding interest rates. The Fed just came out last week and had an announcement regarding the rates. And finally, I'm going to talk a little bit about loans, loan comparison, FHA loan versus a conventional loan, and what the difference is between these two. So any questions, any comments, please go ahead and put them down in the comment section, and I'll be glad to answer any questions that you have. As some of you might know, I do have lots of experience in the mortgage industry. Part of my career was spent in the mortgage industry as a loan processor and underwriter. So I'm going to go a little bit over these topics, and any questions, please go ahead and again put them in the comments. And if you like this video, please hit that like button. And if you like what I'm sharing here, please go ahead and hit that subscribe button. So thank you very much, and let's get started. Great. So on our first topic, like I mentioned, we're going to talk about conforming loan limits. And just to give you a little background on that, the FHA, or the Federal Housing Administration, comes up with the new loan limits every year. Basically, every year they review home prices and determine what the median loan limit is going to be. And they usually announce that at the end of the year. 2022, they just announced it last week. And the new median loan limit is going to be $726,200, up $79,000 from 2022, which was $647,200. So there's a difference of about $79,000. So what that means is now you can borrow more with a conventional loan or FHA loan. So that's basically what that is. And like I said, every year the Fed comes out with this number, and obviously it goes up every year since the value of homes go up every year. So for 2023, our new loan limit is going to be $726,200. Now, this is our base, and they go from this number to determine low value areas and high priced areas. So like I mentioned, we do have high priced and low priced areas. Orange County is considered obviously a high priced area. So the loan limit in Orange County is actually $1,089,300. Sorry, I had to make sure I was writing that right. For Orange County. Okay, so this is the new loan limit, which is great news for people that are trying to qualify. Home prices, as we know here in California, have shot up dramatically. So they had to adjust these limits in order to meet the demand. So now the minimum loan amount for a conforming and FHA loan is $1,089,300. LA, another county, another high-priced county, LA gets to enjoy the same amount. Like, let's say, for example, Riverside, which is not as high-priced, the maximum or highest loan amount in the county of Riverside will be $726,200. This is for Riverside. This is just to give you some idea of the difference between what high-priced areas are. Riverside is not considered a high-priced area, so they maintain the median amount. And some areas that are priced lower, they do have lower loan limits. So that is what conforming loan limits is all about. But what it means to you is that you can actually borrow more, you can afford more, and you can qualify for these loans that you were not able to qualify before with the higher amounts. So, for example, a home worth $1,200,000, you're putting down $120,000, then you could get a loan for around $1,070,000 and still buy the property. So it does help homeowners. It helps affordability. It helps you qualify for a conventional loan or an FHA loan. versus having to do a jumbo loan. Anything outside these numbers is going to be considered a jumbo loan. So anything above 1,089,300 will be considered a jumbo loan. With a jumbo loan, what that means is you're going to have stricter guidelines. It's going to be harder to qualify for. So this announcement is great for people that can only go conventional or can only qualify conventional because the restrictions are less. Your debt to income ratio is going to be higher on a conventional loan versus a jumbo loan. So that is a little bit about that. Again, if you have more questions, please write them down in the comments. But I just wanted to give you a basic explanation as to what this conforming loan limits mean. If you ever hear conforming, that means it conforms to Freddie, Fannie Mae guidelines. Anything outside these numbers, higher, is going to be considered a jumbo loan. All right, so our second topic, we're going to be talking about Fannie Mae, Freddie Mac versus an FHA loan. These are the two major type of loans that we have here in the US. There is other type of loans that I'll go over in another video. But today we're just gonna focus on these two. They're the most popular, and I just wanted to show you a little difference between the two so you understand what you're getting into and you know which one would be most fitted for you. First of all, let's start with DTI. That's basically debt to income ratio. That's the ratio between your debts to your income. Very simple. So you make $10,000 a month, your debts are $5,000. You divide those numbers, and that's how you get to your DTI or debt to income ratio. So for a conventional Freddie Mac, Fannie Mae loan, also called conventional loan, for these type of loans, the DTI usually the max is going to be 45%. Okay. In some cases, if you do have enough what's called compensating factors, so let's say your credit score is high, you have lots of reserves, they sometimes will let you go up to 49.9% to qualify. So that is our DTI ratios for a conventional Freddie Fannie Mae loan. Now FHA does have more flexibility. That's why a lot of people go FHA. It does give you a higher threshold for debt to income ratio. The max here could be up to 55%. Okay. Now, some factors do have to come into that. If you have really low credit scores or things of that nature, sometimes it might limit you up to 50%. So it just depends on your scenario. But FHA in this case does give you more room for the debt to income ratio. Next, we're going to move on to the down payment. Conventional loans do allow 3% down payment. FHA does the minimum 3.5%. So FHA does ask for a little bit more. Conventional, you can go 3%. Usually conventional, we'll talk about it, is going to require a higher credit score. So we'll move on to the FICO. Next step. Fannie, Freddie conventional loan, the minimum FICO or the minimum credit score that you need in order to qualify is going to be 620. Anything below this, you will not qualify for a conventional loan. Now, FHA does allow you to go all the way down to 580, which is great. Gives you a lot more room to play with. 580. Now, FHA does allow you to go lower on that, but you will have to have a higher down payment. So right here, if you can put 10% down on the loan, then FHA is going to allow you to go all the way down to 500. You could have a 500 FICO and still qualify as long as you put 10% down. If you're only putting 3.5% down, then you need a minimum FICO of 580. So again, FHA is going to give you more flexibility. It's going to allow you to bring down those limits, but again, you need to have the 3.5% or the 10%, depending what your FICO is. So that is the difference between Fannie and FHA when it comes to the FICO score. And then lastly, I wanted to talk about mortgage insurance or MI. Mortgage insurance, for those of you that don't know what it is, it's basically anytime you borrow over 80% of the value of the property, so your loan is over 80% of the value, then they're gonna add an additional fee, which is called mortgage insurance. Basically, it's an insurance on the mortgage that you pay so that the lender can do the loan for you. Basically, you're insuring the loan. You're going to pay an extra fee to insure the loan because it's a riskier loan you're borrowing more than 80% of the property value. So in this case, with Fannie Freddie, MI is all dependent on your FICO score, on your credit score, and other parameters that they use in order to determine what your MI is going to be. So it's a little different than FHA because FHA tells you upfront what it's going to be. Now FHA has two different mortgage insurance fees. One is going to be an upfront fee. So when you get the loan, they're going to charge you upfront 1.75% of the loan amount. 1.75. To make it simple, if it's a $100,000 loan, they're going to charge you $1,750 upfront to do the loan for you. Now, besides that, they're also going to have a monthly MI that you'll pay with your mortgage payment every month. This is based off 0.85% of the loan amount. And what they do is you take your loan amount times 0.85%, and then you're going to divide that by 12 months. And that is how they arrive at your monthly mortgage insurance. So again, on a $100,000 loan, 0.85 is $850. If you divide 850 by 12, that is going to be your monthly MI with an FHA loan. So as you can see, FHA gives you a lot more flexibility, but it's going to charge you more when it comes to doing the loan upfront and then your monthly MI. Now with FHA, your mortgage insurance never goes away. As long as you have this loan, you're going to be paying that mortgage insurance. The great thing with a conventional loan is that when you reach 80% value or 80% loan to value, then you can actually call your lender and get rid of the mortgage insurance. Usually they'll have to do an appraisal or have to come out and reappraise your property, but you can get rid of this mortgage insurance without refinancing. With FHA, the only way you can get out of paying that mortgage insurance is going to be refinancing into a conventional loan, because FHA, no matter what you borrow, you will always have to pay an MI premium. So that is a little difference between the two loans, and just wanted to share that with you guys. Again, any questions, please put them in the comments. All right, so lastly, I wanted to just give you a quick market update. Sorry I had to move from my current location. The sun came in and just not letting me see too well. So I went ahead and moved in. As far as the market update goes, the Feds did come out with an announcement last week. Everybody was expecting or thinking they were going to raise the rates another 3/4 of a point. The great thing is that they announced that they will not be raising the rates as aggressively as they had before, which is great news. They actually did not raise the rates this announcement last week. They did say by the end of the month they were going to do another hopefully 1/4% rate raise, which is great news. What that did is that brought the mortgage industry into realizing that the Feds are slowing down and the rates have actually stabilized around 6 to 6.5%. So that is great news. Like I said, they are looking to raise them probably by the end of the month, but it's going to be a lot less than what they have been doing for the last 4 months, which has been 3/4 of a point. So we're hoping maybe for a 1/4 point, which will not change the actual rates by much. Right now, like I said, you could probably lock in a rate between 6 to 6.5%, depending on your situation. But wanted to share that piece of news just because that means for somebody that's looking to buy, the rates are stabilizing. We don't expect to have them go up above 7%, which is going to bring a lot of people back into the market that are looking to buy. So if you are looking to buy, don't wait too much, because again, once a lot of people get back into the market, then the prices are going to stabilize, and most likely those deals that are happening right now will not be available. Right now, sellers want to sell and they're looking to negotiate. Next year, if the rates continue to stay where they're at, a lot more people are going to jump back in. And what that means is that there's going to be less opportunities, more people looking at the same homes. Again, remember that inventory is still very low. So if enough people jump back into the market, then the prices and the negotiations are going to go away. And that's what I'm hoping to do for you guys. If you look at starting to look now, you might be able to still get a great deal. So any questions, please call me. And again, if you like my video, please hit that like button and subscribe. In the meantime, have a great holiday.